Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. All right, everybody. Good morning. Welcome back to another stream. Happy Tuesday to you. And I hope everyone is doing well. Today, let's take a look at what's on the horizon in terms of things to do. Pull up Forex Factory quickly. We did get some information from the RBA, which is, of course, the Bank of Australia, right? Central bank there. They decided to actually keep interest rates steady. They were expected to cut interest rates, and we did see in response to that, the Australian currency strengthening against several other ones. You can see the Australian dollar bouncing up. Let me see the 1 hour chart. You can see the Australian against the Canadian dollar here, pushing higher. So on the Forex front, that was a little bit of news here that took place. In terms of the stock market, you do have stocks moving higher today. And you may notice I'm working on something right here. I'm putting up my wallpapers. If you remember in our last office, I had the themed wallpaper. I think it looks nice. In fact, let me just go. James, could you put me full mode for just a second, full camera? So I'm in the new space, right? I like this color. Julie picked it out. Now, if you picture the rest of this wall, like ignore the white wall, it's going to look really nice, I think. And it actually looks darker on camera. In person, it's like a matte gray, but then on camera, it looks pretty dark. I like it. Looks really cool. We're going for the studio setup, but I was setting that up this morning. This stuff is actually removable wallpaper, and it's pretty cool. So I was setting up the removable wallpaper. It's a pain in the you-know-what to set up, but once it's up, it looks really nice. So anyways, let's jump into some charts. That's the manual labor component of my work today. NASDAQ's up 0.5%. Let's just take a look around the room here quickly. So you've got S&P 500 here moving higher, NASDAQ pushing higher, Russell's moving higher, Dow Jones pushing higher, and the dollar actually moving higher today. Interestingly enough, we'll look into that. You have oil moving sideways here this morning. Bitcoin's moving higher up to 109 this morning. Gold flat to down. And can you check the COT report? Yes. Let's check the COT report because we do have that information now. I believe. Let's check. Yep. So we've got some fresh COT report data, ladies and gentlemen. And look what we have here. SPX and NAS. Big buys. Whoo boy. Look at this. So this is actually very interesting. And now you guys are probably going to guess. Anybody want to guess what my title and thumbnail of the week or of the day is going to be for the main video? Hint, it's 2 words. Anyways, SPX, NASDAQ. Look at this. What I really want, if you're somebody who's new to COT data, really, you can look at all sorts of fancy stuff, but this is it. Oh, you guys know my game way too well. I think I'm getting predictable. They bought. It's happening. Oh, that's a good one. I'll use that sometime. They bought, melt up, they bought. It's one of those things. If you're a regular, you're in on the joke. And if you're not a regular, you're like, Nick is an annoying clickbaiter. And I get it, but I've gone on this rant 37,000 times. Can you imagine if you spent an entire summer painting a beautiful, and this is a way exaggerated analogy. You paint a beautiful picture all summer long, a painting, and at the end of the day, you finish this painting, your heart and soul went into this, and you were expecting to put it up on an art gallery where thousands of people would see your work. But instead, it gets thrown in the janitor's closet and stomped on. That's what happens on YouTube if you make boring titles and thumbnails. And so people sometimes they're like, Nick, your titles and thumbnails are so dramatic and they're so annoying and they make me, but it's again, the reason you see my videos at all is because the videos sometimes, I mean, I don't have crazy views on YouTube, don't get me wrong, but the reason you see my stuff at all is because we've done our best to make it content that appeals to the algorithm and people click it. Right? So people love to complain, oh, your titles, thumbnails. But like people who know, they just get it. They're like, okay, yeah, that's what you have to do on YouTube. Otherwise, your stuff gets shoved in a janitor's closet. Ball out's in on the joke. I mean, if you're in on it, you like the thumbnails, you think they're funny, they're dramatic, and yes, they're ridiculous, but that's the point. It's almost kind of like a fine. If YouTube wants me to play that game, I'm going to play that game because otherwise nobody sees our videos. Trust me, like we've done cross comparisons. If I make a title that's just like, here's some trades that I'm looking at today, it gets like 1,200 views. And if we do a video that's like, you know, me freaking out in the market dropping like crazy, which tends to happen a lot these days across different stuff, those videos would get 10,000 plus. Anyways, that's my rant for the day. Thank you guys for hearing me out. Now that I have everybody's attention with my complaints, SPX and NAS, I mean, this is big buying. This is a pro-US week in terms of COT data. Look at the top three. You got SPX, the NASDAQ, and the US dollar. Other notable buying contenders, NZD, love to see that. The Australian dollar got a bid. Interestingly, COT shows institutions buying right before the RBA surprised by holding interest rates instead of cutting them. They bought gold and silver. Check this out. Institutions went long gold. Decreased short contracts, increased longs. That's a very bullish week for gold. Silver, they decreased longs and decreased shorts, but noticeably they decreased shorts more. You guys like when I do these COT report breakdowns? If you're like, put a 1 in the chat if you want me to do more COT content, and put a 2 in the chat if you're like, no, this is boring. Move on. I do my best. As I just got done complaining to you guys about, I'm doing my best as a YouTuber to make content that people, you know, resonate with. What I don't love so much is take a look at my poor old Russell. I'm long the Russell, and institutions sold it heavily. Added shorts, decreased longs. Interestingly. Okay, that's a lot of ones. I'm glad to see that. Because you guys know I love tracking the COT report. It's a fascinating subject to me. That's why we've, you know, built such extensive tools around it. Okay, now I'm going to leave it up to the audience on this one. One asset. Pick one, and I'll do a COT data history. We'll take a closer look. Do you want me to look at the dollar? Here's your options. I'm going to narrow it down because people are going to have all sorts of options. Give me an option of USD, NASDAQ, or gold. Let me know. Which one are we looking at? We'll look at some history because I think this is important. Not only do you want to, okay, if you want to really analyze the COT report, you need to have everything in front of you, first of all. Second of all, you need to look at not only this week's report, right? You want to look at it all. People ask me, Nick, should I just be looking at net positioning? Should I look at latest weekly COT buys and sells? Should I look at history? The answer is yes, yes, and yes. You should look at all of them. Why would you not look at all the available information to track institutions that you possibly can? They're the winners in this game. They dominate this game. Why shouldn't we look at what institutions are doing? Okay, gold is the clear winner. So we'll take a look at gold. Okay, so I'm going to switch over to gold here. And what we'll do is this is what I want to show you guys. How do we read this chart? Because this chart alone of the three is the most powerful, in my opinion. You can look at the net positioning. You can look at the weekly buys and sells. I like those two a lot, but this is the most powerful chart that I have to show you guys on COT data that we've built. So if I'm looking at gold, right? If I want to look at closer at gold specifically, and I want to say, are big institutions out there, the big money, are they buying or selling gold? Well, I can show you something crazy about this. Ask yourself a question. It's a rhetorical question. You don't have to answer in the chat, but answer this to yourself. Have you been short gold at all, even one time in the last few years? If the answer to that question, you just said, yeah, I've been short a couple times. Let me ask you a follow-up question. How's that worked out for you? Feel free to comment in the chat if you'd like, but I'm going to tell you that the vast majority of people who shorted gold in the last few years have been in pain. Now, I say that as if I know what it's going to do next. I'm not telling you like, oh, it was obvious not to short. But do you know who was long the whole time? Institutions. Aggressively long. Long. I mean, you can't find an example here, ladies and gentlemen, on the COT data history tab. You cannot find an example in the last few years of institutions actually getting short on gold. They've been long the heck out of this thing, right? So if you're not aligned with the institutions, if you're not following along with what big money is doing, right? And big money's not always right, but you tell me where on this chart institutions got it wrong by staying long. And I'll show you the COT data history, which has been aggressively long for a suspended period of time. Now, how can we read this for everyone at home who's new to the COT stuff? We're tracking institutional money week to week. The yellow line is really the simplified all you need to know line for COT data, okay? That blew my first account 18 months ago. Yeah. Short only once in 2024 and it was break even. There will be a time to sell, don't worry. You're correct. But how can we know when the time is right? Well, I'll tell you one thing. It's been really hard to be short because big money keeps buying the heck out of every dip. I can show you that. I'm not speculating that. I'm not telling you, oh, this magical candlestick pattern is telling me that. No, I'm showing you the data. The CFTC's weekly required filings show us what institutional money is doing. We've just built tools that make it possible for you to see them easily. So we can spot institutional money flow. Check this out. So the blue bars are the long positions, right? The red bars, and these are institution filters, right? So we're looking at net non-commercials. These are your hedge funds, banks, large speculators in the financial markets, reporting to the CFTC their positioning. What you see here is a whole lot of blue versus a very little bit of red. The vast majority of positioning on the institutional side of things has been very long gold. Now, the yellow line simplifies it further and just shows you the percentage of longs versus shorts over time. And when I said you can't find an example in the last few years of institutions being net short, what we call net is a 40% or less is a minority and a 60% or greater is a majority, okay? So if we're hovering over this yellow line again, look, 76% long, 78, 79%, 76, 64, right? The lowest it got was 59.67, which if you rounded that to the nearest whole number, that is still 60% of positioning was long, even at the most proportionally bearish moment for institutional money, they were still very heavily long. Institutions for the last few years have been heavily long on gold. Have they been right for doing that? I mean, you tell me, look at the price of gold. They've made a killing institutions who were riding this trade long. Again, people love to think like, oh, they're selling into this, they're moving against, they're gonna take everybody's money. Well, maybe they will when it eventually turns, but if you've been holding your breath, you're probably passed out right now, right? Because it's been a long time where institutions have not only been long for a long time, they got more long. At one point, they were 90% of their positioning was on the long side of gold. Are you kidding me? Going into 2025? I mean, that was a mega profitable position for institutions, right? So we've built these tools. We've spent the last few years building these things to really hone in on how we can track institutional money flow. If this is something you're interested in, if you want to get a copy of this for yourself, now's the best time of the entire year to do so. We're offering 45% off for anybody who's watching this live stream right now and sends a direct message to our support team. You can get a copy of what I'm using right now to analyze the COT data history, the COT data weekly filings, and the COT net positioning. All of that is yours to use within the EdgeFinder. Of course, COT data is sent out weekly by the CFTC, but it's delivered in a giant, ugly text file. What our company does is we build visualization tools to make these opportunities easy for you to spot, so you don't have to spend 4 years of developing in order to build these kinds of tools that we've built. So if you want access to the stuff that we've built, again, we're a small company out of Atlanta, Georgia. We build all sorts of different dashboards and tools for traders. If you're new to the channel, consider getting a copy of the EdgeFinder for 45% off for a limited time. Our support team can be reached by sending a direct message using the link just dropped in the chat right there. I've seen that text file, and man, it's ugly. Glenn, I'm telling you, man, that's why we're in business, right? At the end of the day, we do the grunt work that people don't want to do, which is we build, all sorts of different scripts and code and API stuff to make this data. If you're a trader, right, your job is not to build dashboards and visualization stuff, right? Let us do that. That's my background before I got into trading, is software engineering, and now that's what we do it's kind of my day job. I trade and I build tools. And so again, those are available now at the lowest price that we offer all year long. Just click the link that's been dropped in the chat right there. If you want more information about the EdgeFinder, go to a1trading.com/EdgeFinder. That's a1trading.com/EdgeFinder. So where does that leave me with gold now? Well, you won't catch me bearish on it. In fact, I haven't been short gold in years. I have not taken a single short position in years on gold, because not only the institutional stuff, but also because of a single other chart that matters substantially to gold. You ready for it? Boom. Let's add 2 years back. Matter of fact, let's do 3 years back. Do you see what we're looking at? If you're a regular stream viewer, take a second to front run what I'm about to say. Why does this chart suggest that gold bullishness has been the path of least resistance? Why does the CPI, which a lot of people only know the acronym and they know it moves the chart, but why does it move the chart? Why does news on CPI spike the charts across everything? Gold, NASDAQ, dollar crosses. Why? Ask yourself why. That's what fundamental analysis is. Fundamental analysts or macroeconomic traders, macro traders, right? They ask the question, why should this cause a trend? Not just trading the chart, but rather, why should this trend continue, or why should this trend discontinue or turn around? This chart right here shows you one of the key reasons why I've been predominantly bullish on gold in the last few years. I've traded in and out of gold many times. I'm not just buying and holding. I'm trading in and out of gold using price action and all these things, but I've only taken longs. The primary reason for that is because cooling inflation, which is what CPI measures, it measures inflation in the United States. Inflation has been relaxing over the last few years. Now, inflation relaxing gives the Federal Reserve more room in their belt, if you will. They can loosen their belt a little bit. Okay, their belts like tighten super hard. They can't hardly breathe with what they need to do with inflation, right? They can't cut interest rates. People are like, we can't afford houses. The cost of living has gone crazy. We need to be able to borrow money, student loans, all these things need to be more affordable to people, right? Well, the Fed can't do much about it if inflation is already high. If inflation's already high and you cut interest rates dramatically, we could send ourselves into a devastating recession because more and more inflation could make things even worse. So inflation has been cooling. Why is that good for gold? I'll tell you why it's good for gold. It's weak for the dollar. The dollar weakens because the Federal Reserve sees inflation cooling off and they say, okay, very good. Now we can cut interest rates. And so that's what we've been gearing up for. We've seen interest rates or inflation cooling off over the last few years, suggesting that the Fed can now start to cut interest rates. Cutting interest rates is bearish for the underlying currency. And in this case, because we're looking at the US currency, right? The US dollar, inflation cooling means the dollar has weakened, strengthening gold. Does that make sense? That's kind of the big picture. You look at COT data, institutions are on the same page of what we're just talking about because we can see it in their positioning, right? We just talked about institutions have been long. It's because they look at the fundamentals, they look at the trends happening in the economy, and they base decisions off of that. If you don't believe me, turn on CNBC and listen to hedge fund managers interview on there. They're not talking about head and shoulders patterns. They're talking about inflation, the Fed, business cycles, earnings, things like that. So that is why we focus on that too. We should be focused on the same things that the pros in this game are doing. They're looking at the macro. They're looking at the economies of the world and making decisions there. So for me, I still remain bullish on gold. I've been bullish on gold, like I said, for a few years, and I have a long position. I think that the path of least resistance for the Fed is to cut interest rates in 2025. I think that they should cut up to 3 times. The market seems to price in about 2. However, we've had some really good jobs prints recently, which have suggested the Fed doesn't need to hurry to cut rates. They can take it slow. We had a really good jobs print. We saw this in the non-farm payroll report of last week, which suggested some strength for the dollar, which put gold a little bit on the back foot. But gold on a price action perspective, when we zoom in a little bit, still holding support really well around this 3,300 level to 3,275 level. We actually came down and tested this area once more yesterday. If we come down and test this and fail here, I'm going to stop out of my trade. And if we start to break out and start moving back towards those previous all-time highs, I'm going to take my stop loss and trail it further into profit. So that's my game plan on how I'm going to manage my gold trade for the remainder of this week. I don't have a whole lot to do in terms of new entries for gold. We've respected this upward trend line over the last few months, or really the last year or so. Nice push to the upside here. I do think that we're coiling up for what I think is a potential break to fresh all-time highs, especially if you want to get there in a hurry. It would be some sort of geopolitical tensions roaring up again, which in today's world, unfortunately, seems to be around every corner. We get uncertainty from what's happening in the Middle East, or in Ukraine, or in China, or in the US. Like, there's just all this uncertainty. And so I think that gold has been a beneficiary in that, as investors have opted to be more on the side of, okay, let's stay bullish on kind of the defensive asset, which gold is. So that's part of the reason why I am still long gold. It's gone from a bullish reading on the EdgeFinder down into neutral. However, COT data with the buy pressure that it had last week gave it 2 more points. So we're up to a +3. A +5 or greater score on the EdgeFinder gives it a bullish rating. Now, if we actually go look at gold a little bit closer here today, the trend filter, if it were to start moving higher, would put gold into a bullish setup. Right now, trend is giving us a -2, as you've had some short-term kind of corrective movement. You can see gold kind of trending lower here in the short term. But like I said, if you get any sort of breakout, you get a couple days up, gold is going to get a confirmed bullish signal again on the EdgeFinder. The other thing kind of holding gold down at this time is you had some strong employment data last week, which gave some negative scores to the unemployment rate and employment change data, right? You had NFP, which came in very strong. You can see it color-coded red to help understand why that's negative. Well, think about it. Stronger jobs reports, not particularly bullish for the defensive asset that people run to when the economy is not looking good. Imagine if you held your gold trade when Israel attacked. Yeah, I mean, gold has had, like I said, I've traded in and out of gold many different times for multiple years. But yeah, it's been pretty much, it's hard to mess up. If you had just bought and held since that time, you would have done very, very well. Of course, that's a lot of hindsight speaking, but you know, I've traded in and out of it, and I still see the bull case at this time, right? I don't see a reason to get overwhelmingly bearish on gold at this time either. So yes, we're in consolidation. Yes, we're moving sideways, but I think that the path of least resistance for gold through this consolidation zone is actually to break out and continue moving higher. At some point, I heard somebody say this in the chat. At some point, is gold going to have some massive downside reversal? Of course, everything does, right? Trends always come to an end at some point. But I want to show you something, you know, that a lot of people miss out on with assets like gold or NASDAQ. These things tend to go up over time. And when they're in bull mode, let me show you this. You ready for this? This pink line is your 200-day moving average. Looking at gold, if we go back to this stretch in 2009, which the world was really scary at that time, you can see that we went, ready for this? Check how many days until we come back just to test the 200-day moving average. Right? This is an example of a metal market bull run, which we're in right now, by the way. Right here, that's the first time we retested officially, and that was 1,052 days in a row that gold traded and stayed above the 200-day moving average. Multiple years without even retesting the 200-day moving average. Let's jump to today, and you can see that gold is having another incredible run without testing the 200-day moving average. So right now we're looking at, 629 days have gone by where the gold chart has not retested the 200-day moving average. Can that continue? Well, clearly it can. We saw 1,050 days. Of course, we could continue to see a continued push higher for much longer than people think, right? People love to try and call the top or end of a trend because it makes them feel like you're not going to catch me, you're not going to trick me, right? But sometimes the biggest fool is actually the person who wants to fight trends constantly rather than just be a part of them and hop off the train when the train's looking like it's going to stop, right? So for me, the path of least resistance, right? Because nobody knows the future here. The path of least resistance to me would be gold to continue to respect its long-term strong uptrend. Do we know when that's going to happen? No, we don't. But we don't have to, right? Trends are just trends. Trends are your friend until the very end, right? That's the oldest saying in the book when it comes to trading. And so when I look at gold, you could try and call the top on gold, but if you go back and scroll through my videos for the last few years, how many fallen soldiers have tried to do that, right? Many, many people have tried to call the top on gold. Every single one of these peaks on my channel, there were comments like, gold's not going to break that, all the fools are going to buy. And then look what gold's done. It's just completely been a massive, massive winner. Anyways, I know I'm ranting about gold for a really long time. Some of you guys are like, all right, move on to something else. Let's do something else. We'll talk about the dollar a little bit. Dollar's making a push back higher here today, up to looking like it's eyeing the 98 level. Past resistance could come into play here. We'll see. Here's the thing about the US dollar. I'm very much on the neutral side of the dollar at this time. If I were to go, let me take a look at economic heat map for the US. You got right in the middle, right? Why? Why did we go from a bearish reading to a neutral reading? I'll tell you why. NFP changed the day for the dollar. We had a strong NFP report and a strong job openings number. Jobless claims came in better than expected. Unemployment rate went down. I mean, that is some strength for the US dollar. So, Nick, why aren't you bullish the dollar? I'll tell you why. Because we also have bearish things on this list. GDP numbers missed completely. Retail sales were really poor. Inflation has been cooling, right? CPI year over year, 2.4%. Fed's going to likely cut interest rates. So you do have some bullish things, some bearish things. But what could change the story a little bit further would be if we were to adjust CPI when it comes in here. If CPI comes in bullish for the dollar. In fact, we have CPI, I believe, next week. Let me just check. By the way, this economic heat map is included. We talked about COT data history. The economic heat map is another very popular tool. It allows traders to source a ton of stuff all in one place, comparing the actual forecasts and previous data. If you don't have a copy of the EdgeFinder, now is the best time of the entire year because we're doing a 45% off discount sale for people who are watching this live stream right now. If you'd like some information about how you can unlock that 45% off discount, click the link being dropped in the chat right now to speak directly to our support team about getting a copy of the tool while that discount is available. It's only available for a short period of time. And like I said, it's the lowest price you can get the EdgeFinder at all year long. It is also a one-time payment to get the EdgeFinder. You're not paying every month. You pay once, you have the tool, you support our work, you get great tools, and all of our future updates are yours for free. So let me continue with this theory here, right? So if we're taking a look at the inflation statistics, we have CPI coming in, I believe, next week. I need to check. Next week. Yes. Yes, we have CPI next Tuesday. So if CPI it's expected to be previously it was 2.4%. We'll get forecasts. If that ticks higher, if we go up to like 2.5, 2.6, the dollar, in my view, at that point would officially flip into bull territory because then you would have had a strong jobs print and a strong CPI report. That's what the EdgeFinder specializes in. It tracks all of that data and weights it heavily, right? So if CPI flips to a hotter than expected print, the dollar becomes a bullish reading within the EdgeFinder pretty much overnight, real quick. But if CPI comes in soft, we stay in this kind of neutral camp because NFP was strong, CPI previously was weak or soft for the dollar, and we'll have to see what the next one brings. Right, so that's what we do. We track the data here. By the way, yellow text represents new data. Last 7 days is yellow text. So fresh data gets color-coded yellow. So we'll see. The dollar, like I said, from a price action perspective, straight up in a downtrend, right? It's hard to dispute. Take a look at the weekly chart, downtrend. Daily chart, downtrend. You could get lower 4-hour time frame. Still a downtrend, right? It's in a beat up mode. However, the dollar index here on a weekly chart, you start to ask yourself, is the dollar really going to go into this long-term secular downtrend? In fact, one of our next guests who's coming on in just a moment, Forex James, I've listened to him talk a little bit about on his socials, this very long-term upward trend that the dollar has been on since like 2008. The reversal, right? The big reversal, 2008. Look, the U.S. to me, think about this. The U.S. products are used all across the world. Most people use Google, YouTube. We're all using YouTube, right? It's a U.S. product. YouTube, Google, Meta, WhatsApp, all these things are American services. At the end of the day, that trickles back into the strength and, reliance on the US dollar. US dollar is king, in my view, for the foreseeable future. I don't see that changing anytime soon. However, we've had a big repricing on the dollar, as now it does look like the US economy is softening a bit. Doesn't mean it's entering into a major recession, but it's softening for sure. And so could the dollar continue to maybe even overshoot that trend line? Possibly. Possibly we overshoot that trend line. Or maybe if we get really bearish stuff going on, maybe we move down to 90, retest this very long-term level of support. It's possible. But I do think that longer term, the further the dollar goes down, the less bearish I get on it, simply because I think the easier trade on the dollar is behind us. With inflation cooling and jobs data softening a little bit, that trades, a lot of it is behind us. I would say more likely from here. Could you get further downside on the dollar? Sure you could. Like I said, I think we could go to 90. I think it's possible. However, I think we're closer to a bottom than we are to a top, in my personal opinion, right? So if I said we're going down to 90, right? That distance, I think we are closer to, which to me, 90 would be a potential longer term bottom. So could this area be here, but I think it requires CPI to come in hot. So I'm not really interested in bearish bets on the dollar at this time. I've been, obviously I'm bullish gold, but that is more a play on the global financial system, cutting interest rates across the board, cooling inflation in the US and other places, and uncertainty. Like it's a different trade than just being short the dollar. Short dollar and long gold are not the same trade. There's some similarities, there's some crossovers, but it's not a perfect correlation. So we'll see. But S&P 500 still holding up pretty nicely. NASDAQ's up 0.3. Russell's taking a push higher. I love to see this. I am long the Russell. It is my biggest winner and biggest trade currently, and of the year. My plan on this one is to look to trail stops again soon. Would be looking for, if we can take out, so this would be my next trailing stop moment. If we can take out these highs, for those of you who are in the signals room, I'm going to trail stops further into profit here. If and only if we can take out the previous highs. So I said this yesterday, but my primary goal right now, my primary job this week is to trail stops on the Russell. But to do so in a calculated way, I don't want to squeeze too tight my stop loss because I want to stay in the trade. So if we were to come down here and test this level in the next few days, as long as we held that area, I'm fine. But if we come down and break, then I need to take profits on that trade. So we will see how that plays out. I'm just going to let the market do what it wants to do. Like I said, I think path of least resistance for the Fed is to cut interest rates, which is why I am predominantly positioned long gold, long Russell. So we'll see how all of that plays out. Before I throw the show over to our next show host, Forex James, just wanted to remind you guys that the EdgeFinder discount is ending soon. It is currently 45% off. Last call on this for the day. Take advantage of 45% off by clicking the link being dropped in the chat or heading over to a1trading.com. Let us know that you're watching the stream right now. We'll give you that extra special discount for a very limited time. Okay, guys, up next, we've got Forex James taking over the show. We'll be right back. We launched the EdgeFinder 3 years ago in April of 2022. And now, years later, the tool has helped thousands of traders take their fundamental analysis and sentiment analysis to the next level. Traders can track things like the commitment of traders data, which shows institutional money flow, whether they're buying or selling certain assets like gold and currencies and indices. Additionally, we've made economic heat maps that allow traders to track easily the fundamental or economic data trends that we're seeing in markets right now. You can also track retail positioning and see what the market sentiment on your favorite assets are right now to look for some contrarian signals. And of course, it strings it all together with the top setups algorithm, showing traders the most convicted top ideas that the EdgeFinder is producing now. The EdgeFinder has helped traders go from beginner to pro in terms of the fundamentals and has helped many traders go from unprofitable to finding the missing pieces in the name EdgeFinder. So if you're not already using the EdgeFinder, let me tell you about the biggest discount that we offer all year long starting right now. The 3-year anniversary sale is going to be our biggest discount that we offer all year long, and it is now available to people who are watching right at this moment. Traders looking to get access to the EdgeFinder can take advantage of this massive discount for a limited time using the link in the chat being dropped right now or in the description of this live stream. If you've been thinking about getting a copy of the EdgeFinder, do not miss this opportunity. It is the lowest price that we do all year long, and it's a one-time payment to get access to the tool. So don't miss it. Celebrate 3 years with us by getting yourself a copy of the EdgeFinder at the super discounted prices. Thanks for watching. And now back to the show.
Hey guys, happy Tuesday. Hope everyone's good. So far, predictions coming true. The dollar seems to have, or starting to show some sort of rejection at the trend here. I'm not going to go into loads of detail about the dollar. I've been talking about it a lot recently, but just for a quick update, last week I said I'd be very, very surprised if we didn't see some buying into the next COT release, which came out yesterday. Obviously, we had the delay for July the 4th, where we did have a slight increase in net positions. So net change percentage has gone up to 3.62, and the overall short percentage has been reduced from 59.25 to 55.63. It's still, in my view, still a very crowded short trade. However, the idea was on point. And if we look throughout history or recent history on the dollar, when we have these crowded periods where dollar shorts are overwhelmed, or not overwhelmed, it's not the right word, when dollar shorts are heavy, we can see here back in 2018 or March 2018, 57.8% were short in terms of COT data, right when we bottomed. Here, back in January 2021, COT is 58.5% short, right around the bottom. This one here back in August 23, it was 58.9. We didn't see as much of a rally, but we did still see upside, the wrong side of that. We've got a very similar situation now, where we've obviously just slightly reduced this 59.25% short, but we are still majority short dollar. So just looking at the COT sort of pattern or trend, cycle, whatever you want to call it, it would signal alone that we might be heading towards a bottom on the dollar. And again, I'm not saying that alone is signaling the bottom. I'm just saying if you use that on its own, then that's quite a nice confluence for a potential a potential long. The monthly time frame, RSI is still in an oversold area. We remain in this uptrend that's been established since sort of 2009, give or take, depends exactly when you draw it from. So to be honest, I'm not really finding any difficulties being bullish. I'm more cautious. I think Nick said he's quite neutral. So I can't remember exactly when, but we do have CPI coming, which will be sort of the final cherry on the top. I think what we've had with the dollar was mass fear, and I think we've priced in pretty much max pain unless CPI collapses, which I don't think it will. It might come down. I'm not sure. I'm not really bothered, to be honest. But I think we are pretty much at max pain. So what we've had, obviously, is, oh my God, Fed's going to cut rates. We've got weak dollar, recession fears, blah, 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 blah. Then we had, okay, NFP was good. Unemployment was low. JOLTS was good. So actually, maybe we front run the July Fed cuts a bit too hard, because obviously the Fed so far seems like they're not going to cut rates here in July. So we might see some sort of repricing. However, I do think we need to see CPI come in on target or above target for us to have any major dollar rally from here. If CPI is relatively flat or lower than expected, I think we are going to creep lower towards this 90 support level that we saw back in 2021. So that's my current view on the dollar. Pretty, just to nutshell it, pretty neutral until we get CPI. That will be the main catalyst, I think, for the next leg on the dollar. There was something I wanted to look at. I honestly didn't realize I was on today. So I'll do this with you because some of you might find it interesting. Some might not care. I don't really trade this, but, oh wait, hold on. That's all right. We'll use Acrobat. So Credit Agricole is short on Euro NOK. And I was wanting to read into this and see what they've got going on, but like I said, I'll do it on stream. So you can see yesterday, Credit Agricole entered short Euro NOK selling. That's the take profit. The stop loss is 2.53% of a price move away from their entry point. Their entry is not listed actually, but I'm sure we could sort of gauge that. That's not really too important. FastFX model, Euro NOK is overvalued and it's triggered another Euro NOK trade this week. FastFX model. So it seems like they're going in for some sort of mean reversion on Euro NOK. So let's have a quick look at the chart. I also want to show you this, which I'll move on to shortly because that's quite cool. It's something I've been looking into. But I've got about half an hour today, so I need to be speedy. Don't have time for slacking. I'll have a look at the chat in a second as well. I apologize. I'm just trying to run through this stuff. So they view Euro NOK as overvalued or overpriced. So we'll just look at the daily, which, to be honest, just from technicals, actually kind of makes sense. But the issue is because I don't think I've ever placed a trade on the NOK, so I've got no idea what the fundamentals are behind it. I'm not really that sure about the euro either. I've been tunnel visioned into the dollar over the past couple of days. However, I don't think euro is in a particularly great spot either. So I think just from a very quick look, if we could break the most recent sort of daily low here at 11.79, that could potentially set up. And again, I'm just going off basic technicals here. I've not done the research really to back it up. But credit agricole there. So there you go. You could go in for something like this with a stop loss just above the 200 daily Bollinger, which is right there, and a take profit sort of at this recent low around here. So that would be towards 11.45. I think that's reasonable. But again, you'd have to do your own research on that. Okay, let me just have a quick look at the chat. No Alan today. I don't think Alan's on today. No, I'm fairly sure it's Chris Pulver. Ball out, you reckon there's another wave down to 95? Fair enough. I saw Lee brought up my birthday. Yeah, I did have a birthday yesterday. Didn't do anything, actually. I was meant to go out, but I'll be honest, it's going to sound a bit nerdy, but I found something, which is what I'm actually going to move on to here. Found something that I really like, actually. And I'm not going to take credit fully for this because it's derived. If you guys know trader Tom Hugar, it's derived from what he trades, which is he calls it the SRS or the school run strategy. Now I've taken it and I'm basically doing live testing. I'm not taking these trades. I just want to be clear. I'm not actually trading this. I'm just testing and collecting data. But I think it's really cool. So essentially the idea is we take the second 15-minute candle of the session open. So in this case, you take the 8:30 15-minute candle in London. Then obviously I'm talking UK time. Then I would take the 2:30 New York candle and they would define the ranges and you would essentially trade the breakout. But I've been doing it on the 5 minutes and we apply an anchored VWAP onto the start of the session. And what we do, and again, I just want to clarify, I'm not trading this. I've not got the data yet to say that this is a profitable strategy. It's why I'm testing it. But I'm just sort of showing you because the results so far are fantastic. So we draw our London range. We apply the VWAP or the anchored VWAP from the start of the session. We wait to see are buyers or sellers in control, essentially like a moving average. Is the VWAP below price, above price? Is price respecting it? In this case, we reject the VWAP, close above the range. We technically just enter the long, and then we have a 1 to 2.5 profit target. And we do exactly the same for New York. And this was the New York trade. I've also tested the London trade here, which would have been break even, depends on obviously where I would have taken profits. And on this case here in New York, it probably wouldn't have been a trade. But yeah, I'm collecting all sorts of data here because obviously I'm at heart or typically a swing trader, which is obviously very fundamental, macro based, but I've never before dived into statistics and probabilities when it comes to just raw price action. So I'm looking for like what's this average size of the range, the points, obviously the size of the range in points, where was the breakout, above, below, the amount of candles within the range until the breakout, the amount of candles it takes to, or on average it takes to hit the target or stop loss, MAE, MFE, all sorts of stuff. But yeah, I'm trying to see if I can build something that is purely statistical based, and then if it can work over a long period of time. So I'm just testing it for like the next 1 to 2 weeks live or on live markets, then I'm going to back test it, because what I don't want to do is sit for hours and hours back testing for something that just doesn't even hold any weight. So I'd rather just place the markups while I'm working, doing about my day-to-day stuff, and then I can just see if it holds something without having to dedicate the time to it. Then the plan is to maybe integrate it into some sort of EA or an algo or something potentially, but that's down the road. That's a different topic. So yeah, that's what I've been doing with my time recently. I managed to get into New Zealand yen, so I'm finally sitting in this trade. So yeah, I'm just waiting to see if we can finally break and hold above the previous highs here. I'm also still in euro pound shorts, which actually are proven to be a little bit tricky. You know, they're a little bit it's a bit messy so far. No problem. As I've already said, I planned one more entry, or I've got one more entry planned, which will be at the previous high right here at roughly 0.871. Then my total, the mental stop would be here for a total loss of 1.5%, which to me is completely reasonable. But yeah, that's it. I've not really got much else going on. I quite like to buy the NASDAQ, but I'm not really having anything that's tickling my pickle too much. I really like silver as well. I spoke about silver briefly, I think on the last webinar or the last stream, but it's just still too high for me to willingly buy it here. I'd really like to see a pullback down to around 34. Then I could justify being a buyer up until 40. 40 has been a long-term target that I've had for quite some time. Dollar yen is interesting as well. So we're just sat within this sideways range. Well, obviously a sideways range, but we're just sat within this range on the daily, which for swing trading makes it a little bit difficult unless you want to try and play ping pong. There's not really anything here. Yeah. James moving like Chris Pulver. Yeah, I apologize. I'm speeding through this one. Like I said, I've got a few different topics. I've actually already covered them, to be fair, but I just wanted to make sure I can cover them within half an hour, because I got used to doing the 1 hour slots where I can sort of just take my time. But yeah, I do apologize for not getting to questions and things. Let me just have a quick catch up. Credit Agricole want to buy, let's sell. Well, I would agree, ball out, but it's a client report. So unless they want the clients to all lose money as well, then I don't think they'd be misleading. A VWAP, too much Cardi B reference. Yeah, you're right, actually. You're in the same euro pound trade. It's doing okay. Yeah, good stuff. I mean, the thing is with euro pound, I don't mind it. I mean, it's a little like, sitting in some drawdown on it, not the best, but because I've been holding for quite a while, the swaps are quite nice. So I'm essentially just getting paid to hold the trade. There is nothing there really to worry about. It's not like I'm paying swaps and in drawdown at the same time, which is why I like euro pound, euro dollar as well, because you can sort of dollar cost average those markets and get paid. So it's pretty simple. Euro dollar is starting to head down. As I've mentioned a couple of times, I do think this market reached a point where it would be very difficult to go higher. I think realistically, it could come to around 1.2. But as I've said, I think I said it last week, but the ECB has already mentioned that if euro dollar does get to, beyond 1.2, it would start causing recessionary concerns, and the ECB is likely to they won't intervene. It's not like a BOJ situation, but they would verbally intervene on the euro. I'm not really sure exactly how that would play out, but I just think with that in mind, are smart money going to want to continue buying euro dollar, knowing that their target is likely around 1.2? Beyond that, it becomes more of a risk to hold that position. Don't know. You can make your mind up on that. The other thing I actually just want to mention. Now, hold on. Let me open this properly so you can see it. I covered this on my channel on Sunday, but I put together a research paper or a presentation on the dollar, and one of the main things that drove the dollar down recently was a lot of hedging. It wasn't necessarily just a structural decline. It's bad data dollar down. It wasn't as simple as that. A lot of it was due to hedging. However, that hedging has now become to a point where it's actually very expensive and it's slightly unprofitable to do this because the yield is negative. So earlier this year, it was, let's say late into 2024, early this year, it was a reasonable thing to do in terms of cost. However, now, not so much. So from a few different standpoints, I just don't think dollar bearishness is warranted. I think you obviously to a reasonable point, I think towards sort of 90, maybe, but I think beyond 90 would become, okay, you're more of a pessimist doomer rather than a realistic macro thinker. But that's just my view, and I'm not trying to insult anyone by saying that. I'm just saying that's just how I view it at the moment. Obviously, you know, I could be completely wrong. Dollar could crash, but I just don't see that happening at the moment anyway. Oh, sorry. I'm just gonna bounce back to one other thing I forgot to mention, was the recession fears regarding the dollar. Makes sense. However, historically, the dollar does very well in recessions. So this is the 2008 recession. I'm not sure how well you can really see this, but I'll read this out for you. The GFC recession officially began, or I'm sort of estimating here, but around the 17th of December 2007. The dollar proceeded to lose about 9%, 9 to 10% of its value from that point. However, once we reached max pain and there was a full recession and the credit event, the dollar then decided to rally 25%, and we were still in recessionary conditions at that point. Same thing in 2020. The dollar surged 9% in 2 weeks. And, you know, obviously we've had negative GDP, which can be a signal towards recession. Again, I'm not saying we are in recession. I'm just saying that is one of the things I'm hearing a lot about at the moment is dollar recession, US recession, blah, blah, blah. Yes, maybe. I'm not going to write that off the table. I don't think that would happen, but anything can happen. But if that does happen, even then, I'm not sure I'd be willing really to be a bull. I might actually more be a buyer of dips on the dollar in that case. Okay, right. That's pretty much all my points done. I've got about 10 minutes left. So let me, again, just quickly catch up on the chat. EU long to 1.19. Yeah, so euro dollar, I think, is due a pullback. Beyond, I think it's due a pullback to around 1.15. At that point, if the landscape is still, okay, dollar's lackluster to neutral, and euro is still presenting strength across the board, then yes, I might look to be a buyer at around 1.15 of euro dollar. But right now, I think it's just too high to be a buyer. I think if you wanted to be a buyer, you've kind of lost the opportunity until we get some sort of pullback. Same thing with the dollar. I think if you want to be a seller, I think you've already missed it until we have another pullback. And then, you know, if you're still bearish, then you could sell the upside. EU, I think best to wait till 1.16 zone. Yeah, OT, I think we've got a similar idea, really. Looking for just some sort of pullback, maybe then to get long. James, the dollar typically of the last 20 years dips on a 3 to 4 year cycle. Yeah, I mean, I don't think I've got the 3 to 4 year cycle here, but I do have the dollar's sort of historical behavior of the recent history. When I say recent history, it goes back to 2008. But we do have, obviously, like any other market, we have expansion contraction periods, or, you know, whatever fancy word you want to use, but I've just called it expansion contraction for ease. But these downsides are completely normal, obviously. But this one here does seem, from a technical point, like it's ready to rip. And again, I'm not saying it's going to. I'm just saying it seems like it wants to, or it seems like it's primed to do so. Whether it will is a different question. But yeah, I'm rooting for the dollar at this point. Let's put it that way. From 2005. So what was it? A 3 to 4 year cycle. I'm going to have a look at that. I'm going to leave that as a note for myself to have a look at the 3 to 4 years since 2005. Let me actually just add 2005 there. So I'll have a look into that after the stream. DXY not going to rip. Maybe not. But again, I just find it very difficult to be bearish at this point. Wow, pound dollar's sinking. I know we had some more news on pound. Again, I've got no idea what actually happened. I saw a Bloomberg alert, but I didn't read it. So I should probably do that again after stream. Yeah, Pound dollar is really not doing well. Let's just see, what is the BOE saying at the moment? Bank of England holds rate steady at 3.85, signals likely August cut amid softening labour market, easing inflation, key focus updated forecasts. Okay. So yeah, the Bank of England's dovish to neutral, and we've got the Fed just sitting right on neutral. Again, we're waiting really for that CPI report. But let's have a look at higher timeframes. Yeah, it's similar to euro dollar. It's not as bad as euro dollar in terms of being at a price extreme, but technically it does also look like it's due for some sort of pullback. So let's just have a quick look. This is, of course, the weekly time frame. So I'm looking on a big scale here. What about the daily? So if we're on the daily, we'd be looking more for this low to this high. So realistically, for a swing trade, I think this is reasonable. So if we could see a pullback to around 1.32, and again, I'm assuming that you want to be a buyer of pound dollar, this might be the opportunity to get long. I'm going to get rid of the weekly fib just for now. But yeah, something like this, I guess, would make sense from a technical view. However, again, I really think being a buyer or seller of dollar, you kind of have to wait for CPI, unless you're obviously in day trading or scalping. But yeah, I'd just be very cautious. Should I gamble life savings on dollar long? Probably not the best idea, to be honest with you. You went long GU a few minutes ago. Very nice. So, Lee, you think 95 as well. Ballout's also saying 95. So let's have a look at 95. I think 95 is possible. I mean, that would line up with previous structure. It's still within the trend. I don't think that would really break anything, actually. When I say break something, I mean it wouldn't break my view on the dollar down to 95. Actually seems quite a reasonable target to have if you are a bear. Theoretical, yeah. Any trades happen? Not from my side, no. I am currently in a euro pound long, staggered or DCA'd, and New Zealand yen longs as well, but that's it. That's all I've got. So yeah, I was looking at I've forgotten the word again. What's the word when you do the opposite of something? What's that word? Contrarian. That's all. So dollar Swiss, I was looking at a contrarian view to potentially get long. I'm not going to, again, not to repeat myself, I know I keep saying it, but CPI really is the deciding factor. So I'm not making any moves in terms of dollar pairs just yet. But this level on a technical basis does look very, very good. We've got oversold conditions, again, from a technical standpoint. We're down at, or currently at, sort of what could be a double bottom that was formed back in 2011. So if you were or did get some sort of signal to be a buyer, maybe we could take it back up into these previous highs on this weekly time frame where we had this triple top and then the dump. That could be a pretty nice sort of 1 to 2.5, 1 to 3, depending exactly how you execute that. So I don't mind that. DAX, I was looking to go long DAX. I think I mentioned this actually. Was it last week or the week before? I'm not sure. I didn't manage to get into it. I think I was looking back here. I just didn't do it. Then I was looking here and still didn't do it. So it's my own fault. I was not vigilant enough. I've been a bit preoccupied recently. So unfortunately not in DAX, but I do still like it to the upside. Pound Swiss, I was looking to go short, but it didn't come up to my entry. I wanted to sell when it retested previous lows, obviously for that break and retest, but we didn't get that. Also, it would have been nice if we could get a pullback into the fib zone, which didn't happen. So there was no valid trade for me there. So that's my watch list. Ball out's in Marbella next week. Enjoy yourself, ball out. Have a good one. Sweet. So let's just do a quick EdgeFinder review before I head off. I've got about 3 minutes left. So what do we have? Eurocard, very bullish with a score of 10. DAX is still 10, which does reinforce the bullish idea I've got. That's nice. NASDAQ as well. I'm bullish on NASDAQ, so it's good to see that in the EdgeFinder. Eurodollar's really dropped. That was a score of 10. It's now dropped down to 6. Obviously, we had COT come out. We've had NFP, JOLTS, unemployment, as we all already are aware. So yeah, Eurodollar's taken a hit in terms of its bullish scoring. Swiss yen's done very well. Sorry, I'm just going to have a quick drink. So yeah, some of you may know I was short Swiss yen. Luckily, I'm saying luckily, it wasn't luckily, but I suppose luckily I was able to view it from an objective side and said, this just isn't working, and cut the trade. So puts me in a tricky position because I'm not really bullish on Swiss yen over the long term, but price isn't wrong. You know, price is never wrong, as the saying goes. So it's very hard for me to sit here and say that I am bearish Swiss yen when it's just breaking all-time highs. So my short thesis is on pause. I'm not going to execute on that until I've got a very clear sign. However, the daily is extremely stretched. I mean, look at the RSI here. It's almost at 100, which is a large amount, especially for a daily. Weekly is also overbought technically, again, just according to the RSI, and the H4 is also overbought. So if you were wanting to be a buyer of this market, I would... It's a little bit risky, but I think looking for a retest of the all-time high or the previous all-time high might be quite a good long opportunity if you were looking for that sort of retest and continuation. Stop loss just below this H4 low, and then you could essentially just have no take profit and trail stops and just let the market run. I think this may be sort of the best opportunity I can find. There isn't really any clean fib pullbacks I can find. I mean, you could draw it from here to there, but even buying at this point will be, in my opinion, too high. This isn't really even the low you should draw a fib from, although it does actually line up. So yeah, there is no fib level to trade from there. So it just have to be really a retest of the previous high. Gold, yeah, we can have a quick look at gold. Me and Bashi will gatecrash your holiday. I've not seen Bashi in a while. I think I saw him last week actually, but he seems to have disappeared a little bit. Look at oil. Okay, we'll have a quick look at oil, then we'll have a quick look at gold. I've got about 30 seconds left, so I'll do this as quick as I can. Dollar strength is obviously not being a benefit for gold right now. And as I've been very open and honest about my view on gold, I'm not bearish, but I'm also not bullish because I just don't have a reason to buy gold right now. But also, again, I'm not willing to be a heavy buyer of the US dollar just yet, meaning I don't really want to sell gold either. So it makes it hard because I don't have any directional view at the moment. You could maybe say the trend line. I mean, that's very rough and very loose, so I'm not really going to sort of warrant that. So gold, I don't see anything. I apologize, but there is nothing there that I would want to trade. Oil, oh, interesting. Oil is making a bit of a comeback here. Now, oil is something I don't really pay much attention to. However, if I could find a reason, I don't know if it's on the EdgeFinder actually. Let me see. It's not. No. Okay, so that's unfortunate because if oil was bullish on the EdgeFinder, I might have considered actually just taking a long position here, but it's not. So that filters that trade out. However, I think it might be quite a nice idea to be a buyer at the moment of oil. And when I say a buyer, I mean more of a long-term buyer because, oops, hold on. What we've had is quite an aggressive downturn on oil since 2023, really. It's been trending down. However, we double bottomed here. Let me actually do a bit of chart art for you. So we double bottomed here, roughly. We created higher lows around here. Then we created another higher low around here. And we've also, oops, sorry, I've got the magnet tool on that makes it a little bit difficult to draw. Then we created a higher high. So if we're just from a technical view, actually makes quite a bit of sense to be a buyer. But again, I'm not really sure what the latest news is with oil in terms of, what's OPEC doing. Has Trump said anything on oil? I'm really not sure. James, do you always trade with such large stop losses? No, not always. It depends on the individual trade. It really, really depends. What do I think about Aussie New Zealand? I was bearish because we had a nice central bank divergence. The RBA was quite dovish at one point. The RBNZ was holding rates steady, so that was a nice factor for for Aussie New Zealand bearishness. However, the RBA held rates, and the labour market's quite strong. Inflation's quite stable, so I'm on it. I'll be honest, from a central bank perspective or as an interest rates trader, Aussie New Zealand to me now has no valid trade. I mean, look at the reaction since we had the hold. So yeah, it kind of ruins that short idea. Oil is struggling to get through 200 EMA on the daily, is it? Yeah, maybe more downside than I'm not 100% sure. Like I said, I'd have to do a bit of research on oil. OPEC's rise in production of oil. Okay, well, yeah, I wouldn't want to be a buyer then if that's the case. Guys, just got the message from the A1 guys. Chris Pulver is here to take over the show. So don't leave when I leave. I appreciate all of you being here. It's good to be back once again, as I've said a few times. But guys, have a great day. I'll speak to you very, very soon. Stay safe. Don't get margin called.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Hey, everybody. Welcome back. Happy Tuesday. Let me share a screen since I'm just looking at a blank screen here. That's a sweet little Jeep, though. All right, screen share's coming in. There we go. So little P&L positive on the day. Got a couple trades running on SPX. I've got a trade this morning if interested in some Adobe. I kind of like the play. I priced it out yesterday. The fill is going to be dependent on how good the price is. Stock is trading at 380, and I was looking at like a 240 by 230 ratio spread. Let me see what this looks like. So if I go Adobe here. I was going out towards the end of the year, either December or January, one of the two. Let's go Adobe. So I can go to Adobe January. I could have swore I wrote this down yesterday. There's a 12/18 expiration that apparently there's not. So there's October or there's January. I'm going to go January. I was looking at the 240 by 230. All right, so this price is out very different than what I looked at yesterday. I don't know if it was just a weird price feed or if this is, yeah, this trade is not nearly as good as what I thought. Yesterday was like showing, $5, $6, $7 credit on a 10 wide ratio spread. Now it's showing a fraction of that. Like I think that's a lot of capital to put out for maybe a couple $100 on the trade. There's a profit trap potential of $1,000. That's just very slim. Unlikely that's going to get hit. One second, sorry. All right. So pass on Adobe. If this was offering like $5 credit or better, I'd take the trade. You know, it's a lot of capital to tie up. Margin accounts to tie up around 10 grand, which is why I would take the trade. But I want way more credit on this trade for a stock that's 200. You know, right now stock's $380. I could maybe justify it if we go back to these lows at 270, COVID lows at 255. So I could bump this up a couple of strikes. But you see, I'm barely getting extra premium here, like going up $10 higher, $10 higher. I mean, that's not a big jump in income. I'm making an extra like $20, $30, $40 to basically move my strike prices by $30. So not super interested in that trade. But okay, so I make $200, tie it up. I'd own the shares at 250, 247, which isn't a bad price if I said I want to own Adobe. Fundamentally, it looks pretty good. I mean, Snowflake checks a lot of boxes. Price to earnings, you know, who's its peers, discounted cash flow. It's like there's good upside to it. Broader market has to be better. And I mean, we've seen the big move in AI. This is not really benefiting from AI. I'm not sure what Adobe's struggle has been, but the stock has been down. You know, one point it was down 61%. Recently down about 45% from the all-time highs. So maybe want to put on the radar. I don't mind this for just a simple income trade. I don't love that I got to move the strikes up way higher though. You know, I'd accept the trade for $200. I'd like to do like a 250. So I think what I might do is this. Maybe set the strikes where I want. So like the 230 by 240 and try to put this in for a 250 credit. And let this one pend. So that way, if the options change or the option values adjust, and this can fill me at 250 credit versus $1.21, I think that number one increases the probability of profit. I get a fill that I'm happy with income wise, and I let kind of price come to me, and it's not taking up a bunch of buying power. So I'm going to put this trade in. It's going to be a pending order at 250, and price would have to fall probably a little bit lower. We'd probably have to slide a little bit lower, you know, maybe into like the 340 zone, maybe 300, and that trade could get filled. If I want to get a little bit wilder and crazier, what would be, let's say we fall down to 330, we're down $50. So if we fall $50, let me see what this looks like. So 40, 30. So right now, if we fall about $50, that would be current price is around 80. So put this around 30. Okay, well, if I'm taking this trade at this level for ratio spread, I'm going to put in a big fat credit then. All right, so I'm going to go 230 by 240 for $1,000. So it's like it's out there. It's like, look, if the option chain gets wild and crazy, give me a good fill, make $1,000. If I'm going to repair the stock, I'm going to tie up 20 grand. Let's make it worth my time. So I'm going to do a 240 by 230 ratio spread, pending credit at $10. All right, so let's go pending, 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 pending. All right, I'm going to put in these counts. So pending order here for $10. Let's get these set up. $16.08. All right, so I'll show you the details of this in just a second. Just let me get these in. 6. All right, so that's a pending order spreadsheet, and then I'll put it in for Pulver alerts. So this is pending, it's not filled yet, but trying to get it filled. All right, here we go. Let's talk some top down. Markets today is still pretty chill. Adobe, pending order on margin accounts. This is my personal tracker. I'm doing a 116.26 expiration. Buying the 240 put. Selling the 230 put. $10 credit. All right, so I'll get that added in. So top down, indexes today a little bit softer. Here's some intraday price, still pretty calm. Between these blue levels are just some market maker areas. So this level, this kind of be the floor and the ceiling for the day. Yesterday, the market kind of hit the levels I expected. I was looking for about a 1.1% move, and we ended up getting it to the downside. So we kind of challenged that floor at 62. We bounced up aggressively towards the end of the day, but a nice little reflexive move based on the VIX rule of 16. Now we're trading kind of flat at 62.20. I wouldn't mind seeing price either one stay flat for the day so I can pull in profit between the two lines, or two either go test the lows or even try to test the intraday highs yesterday if we're going to go anywhere. If we go nowhere, that's fine. But if we go somewhere, I've got a couple trades running. Intraday levels here as well. I talked yesterday about the wave counts. This 5-wave count. If everyone saw this morning, at least from what I read, we have an extended deadline in tariffs to like August 1st. So everything Scott Bessent said is like, we're not moving the deadline. Everything Trump said, we're not moving the deadline. We just move the deadline. So August 1st is now the deadline. The market doesn't seem to care that much. I think this whole notion of, it's not really like the U.S. at this point. I think the world thinks it's not a trade war. It's just the U.S. is trying to put in some deals. Those deals are supposed to be announced. What that means is it already priced in? I don't know. This big beautiful bill, I don't know. I mean, it seems like a lot of things that have been leading to this recovery have been priced in, and a lot of bad things continue to just stack up on the left side of the column. And is it enough negativity, enough worry and uncertainty to then, get this market to at least fall over a little bit? I'm not saying huge bear market. I'm not saying anything like that. I'm just saying just a correction, So this is the wave count we talked about yesterday. 1, 2, 3, 4, 5. So from there, I'm just looking for an A, B, C. Pull back to, I'll put a couple levels here, pull back to this previous high or pull back to this low. That's either going to be around 5,900 or around 5,700. To me, that's a good technical spot. If I'm a buyer, that's what I'm waiting for. Right? I'd like to see a pullback into those areas so I can get some dips and start positioning some fresh cash positions in that space. I don't know what the catalyst is going to be. Unfortunately, we just don't see the market just roll over by itself. It's usually a myriad of news that has to roll in with it, and things get really nasty and scary. We have like a nasty down day, and then the market panics. It's like the amount of emotions that the market makes you feel or wants you to feel every single day it will drive you insane. If you get caught up in the news cycles, you will go crazy trying to trade the news, because it will never make any sense on good news is good news and bad news is bad news. Then it flips. So that's why price is the most important thing. I still think the market needs a pullback, but price has not done anything to suggest that. Price has not broken any major structure. Price has not broken any recent lows. And so, if it happens, okay. But that timing is, I think by August, September, this market's probably going to have some type of correction. I would like to think it happens in July, because we've had a 60+ day melt up and we're 300 points away from the 50 moving average. So to me, that move right there, we're 300 points extended for the 50-day moving average. There's not a lot of times I've seen the S&P that does that. So at the very least, I think a pullback to find that 50-day makes sense. but does it chop around first and then come down slowly? Does it chop around first and have one big sell? I don't know. It could be, I just think it's going to get found. I think we're going to have a pullback, and that pullback to a 50-day, maybe a dead cat bounce and one more flush down would be great, because as a buyer, I'd love to buy that market and get back to all-time highs. Okay. All right. So just some price action there on S&P and the NASDAQ. You can look at all of them. I mean, here's the NASDAQ, same thing. Similar structure. So big move on the 9th, pullback, push into this level, tiny little pause, finishing move. There's 5 waves. So if it's 1, 2, 3, somewhere here, possibly somewhere here. So if you like, buying the NASDAQ or positioning the NASDAQ, this area to me, between around 21.6 and 20, let's say 21.6 and 20,500. It's a wider area, so obviously a much more expensive index. Or you can look at the Qs and kind of play that comparable area. But somewhere between about a 5 to 10% correction between the S&P and the NASDAQ, to me, are playable. I'm not shorting. Okay, I've got a couple of short-term plays, but it's not like a full-on hedge like I have in my portfolio. Those are out to December. But if we get a little short-term correction, great. I'm still going to position bullish. Okay, go to the Dow. Similar, we just didn't take out the highs. On the Dow, low to high, pullback, push, pullback, push. Just shy of the all-time highs. Again, if we have an ABC correction, pulling back to this level, pulling back to this level. I did look at a 111 trade on the Dow. It's okay. There's just a lot of drawdown potential. So my preference would be, if we see a correction first, I'm going to use that correction to then position for a Dow 111, which is I buy a bear put spread and I sell a naked put, and that gives me credit with a high probability plus a profit trap. If price goes up from there, I just collect income. If price falls, I've got a big profit trap where price can be, below a certain level, above a certain level, and it's a profit trap. So a couple ways to play that. I'm going to do that pretty much on everything. I'll do it on the Russell, the Dow, the Qs, or the NASDAQ, and the S&P. Just because that's what I've been literally waiting for the last month. As we melted up through June, now it's in July. We'll see. But I'd like to see a pullback here between July, August, September. I think the market's going to have something. July 30th, we have a Fed rate decision. They're not going to do anything. According to the Fed watch tool, it's still a pause. Is there any language there? Do we have weaker job numbers? Do we have higher inflation numbers? Looking at true inflation readings, third-party inflation is suggesting that we're going a little bit lower. So we rallied from like a 1.2 to a 2.2. So we had like a 1% rip in inflation, and then we've come down pretty aggressively. So again, does this get reflected next week in CPI and PPI data? Maybe. I don't know if there's a forecast out for next week. Let's go to the Bloomberg calendar here. Let's go to next week. This would be next week, Tuesday, Wednesday, Thursday. Oops, there we go. So core PPI and CPI. CPI is on Tuesday. I'm looking at year over year. So previous was 2.8 for the core, and the headline CPI was 2.4. Okay, so core is 2.8, headline is 2.4. From what I read in the Atlanta Fed, they're looking at a 2.6 for headline. Looking at 2.6, and the core was looking at like a 2.9. Again, inflation is not going down if these are the numbers that we're getting. So this will probably print on the calendar next week. I'm curious what the forecast is, but I think both of them are forecasting, higher levels. Question, of course, is we're forecasting higher levels. Do they come in lower? Based on third-party readings, maybe it's gone down. My son says you're drawing some lightning. Yeah, I mean, could be that. Here's a lightning bolt for you for 5 waves. 1, 2, 3, 4, 5. And then you get an ABC correction. Usually ABC correction is in here. And then the trend resumes. So, and I'm not like a huge Elliott wave person. You're never going to see me draw like lowercase letters, uppercase levels, and Roman numerals. And it's not that type of Elliott wave. To me, it's like if I can spot a pretty good wave cycle, that's easy enough. So it's got to be pretty easy to see if it's at support. I'm looking for a 3-wave move, right? I mean, the easiest way to catch a big trade is if you're at a low and you get a 1, 2, 3. That is my favorite trade. Is if you can, 1, catch a bit of the bottom at support, and 2, get a 3-wave move. That's where the market's the most impulsive and the strongest. That 5th wave is usually the slowest, but it still gets to the destination. It's just, to me, it's like, how much conviction do you have to get into these trades and hold these things for 5 waves versus if you can, plot a good technical support level, you can buy low enough and you can get that, 1, 2, 3. That's a great trade. You get a ton of profit in a short amount of time. If you're at resistance, same thing. Resistance, if you have we hit that 5th wave extension, you get a B, C, or 1, 2, 3. I love that trade right there. Also, I don't get greedy on the downside, because a 4th and 5th wave to the downside, especially in a bull market like the stock market, is rare. Okay. All right. It'll be 2 years before lower inflation is notable. Yeah, maybe. But, the question on inflation is like, if it's noticeable, is it because we're already in a recession? Is it because we're already seeing deflation? Is it because there's already pressure on the consumer brakes? Like, I think that's what's so weird about this year. It's like everything is going along and the market's just kind of doing its thing and plugging away. The market's climbing this wall of worry again and again and again. And now you have on like one column, it's like hope and pray and optimism. Okay. And then the other column, it's like reality and a lot of negative things that are stacking up. So the market's just not paying attention to reality, but it is paying attention to like all this like forward thinking optimism, which isn't a bad thing because the market's always typically forward thinking. But our market breadth isn't as good as it was. Again, we're still pretty concentrated. The only thing that's really been popping to the upside has been Mag 7's been underperforming, but like AI has been catching up. There's been a bit of a rotation outside of Mag 7. We had it early in the year in February. It started to rotate a little bit, but like Mag 7 came back. I mean, Microsoft's all-time highs. Tesla, what is it? Apple and Google are kind of like the laggards of Mag 7. Like Apple down, like I'm talking not back to all-time highs, but Microsoft ripped like crazy, Meta ripped like crazy. Nvidia's up to all-time highs again. Like those have been 3 big contributors to the Mag 7 recovery. Apple's down, Google's down, Tesla obviously one of the worst performing Mag 7s this year, and maybe by the end of the year we're not even calling it Mag 7 anymore. But point is, it's like not everything is popping. Not all the growth stocks have had their flush and ventilation. Palantir's doing fine, but it seems like it seems like a type of year that if you're getting great stock picks, there's plenty of gains out there, but I don't trust the sustainability on some of those big runs. When you've seen like AVGO rip up 100%, I think that a pullback is likely. So I do wonder if like there's better rotation elsewhere if the market does broaden out. But to do that, like we saw in February, March, the market broadens out by having a flush lower. Market broadly flushes lower, and then positioning goes into cheaper, more kind of value-driven positions. So it could be an interesting like summer. We could start seeing some sector rotation this summer before we get out of like August, September. And we'll find out in a week or two because earnings kicks off really next week with financials. Then we start to see Tesla get sprinkled in shortly after that. So here's a quick look. If we go to, oops, wrong website, StockTwits, earnings. So the 14th, this is when financials start to kick in. So Tuesday through Thursday, a decent bulk of the week are financials. So, I mean, some notables here. Let's just go Tuesday. JP Morgan, Wells Fargo, Citigroup, BlackRock, Bank of New York, State Street, Fulton. I mean, it's all financials. That's Tuesday. Bank of America on Wednesday, Johnson & Johnson for pharma, United Airlines. We have Delta this week, Goldman Sachs, big one for financials. Alcoa, aluminum. That's an interesting play. I have some shares of Alcoa. Morgan Stanley, PNC, Progressive, little insurance action. Okay, so again, a lot of financials kicking things off. Netflix has earnings on the 17th, so next week we get a little bit of excitement there with Netflix. Mag 7's the week after. So Netflix, high flying. I mean, it hit all-time highs from the last earnings report, drifted higher. Anything else here? Mostly financials, Citizens Financials. And then the next week would be more of your exciting plays, 14th to the 21st. Taiwan Semiconductors, Kinder Morgan in the energy space, semiconductors, Tesla, AT&T. Like, there's got to be more interesting stocks than that. Let's go Afterbell, Tesla, AT&T, QuantumScape, Chipotle, IBM. Las Vegas Sands have some exposure there. Deutsche Bank. Let me see what old Barclays is doing. I was in Barclays for a while. Yep. Fudge. I don't think I had BCS anymore. I took profit on it. I had a bunch of puts in Barclays. BCS is no longer in. So that was a trade through 2024 for me. Basically, it was like a naked put leap. Went out a year and staggered in a bunch of puts at, like, 10, 9, 8, and paid really well. This stock has gone, I mean, impressively, a little bank stock from end of 2023 has doubled in value, up 200%. That's not bad for a little bank stock, Barclays. So I took some good profit out of that one. But anyway. All right, let's continue going top down here. DXY, dollar index. As I mentioned, I expect the dollar catch a bid. It's catching a bid. Overnight, the Reserve Bank of Australia did not cut rates. It was forecast that they cut rates by 25 basis points. They did not do that. So that was a big pop in the Aussie today. There's currency strength. Aussie, got a big pop there in the surprise pause. And, is it going to fade all day today? Probably not. I hope not. I like seeing the, I'm long Aussie CAD, I'm long Aussie New Zealand, and I'm long Aussie Swiss. So hopefully that's at least helping maintain those positions and looking better. Dollar index is catching a little bit of a bid here for 3-4 days. And, a little trend line break goes a long way. If we hit the trend line and sell off again, that's okay. But I'm still waiting for, if we end up getting a bid through this trend line, then a pullback and a go, or a pullback to the lows again and a bottom. I still expect this to pull back to like 100, 101, or 102. Does it make me want to get long the dollar? Not necessarily. It makes you want to get short at a better price. Getting short here around 101, getting short here around 102 with some confirmation goes a long way. If we come back and revisit the lows, it's a great trade. I think the dollar maybe ranges. If you're lucky as like a bigger secular bear market, you get to move back down. I think 90 is a pretty solid round number and destination for the bears for the dollar index. Which means, I mean, again, think about your currencies you trade. Euro dollar could be a beneficiary. Aussie dollar, New Zealand dollar, dollar CAD could come down to the 1330 handle. Pound dollar might be okay, but yeah, I mean, honestly, I feel like Aussie and New Zealand dollar could both be positioned pretty well to have some, somewhat of a yield, especially once the Fed starts to cut, later this year. So we'll see. Okay, but this is why I said don't sell the dollar into these lows, because it's already been pushed down. It's already been beat up. It's like one of the worst starts in history for the dollar index for the first like 6 or 7 months of trading. And we had pretty easy oversold conditions with a lot of divergence. So that's why I wasn't selling into the lows. Okay, oil, finding some good support here around the 65 handle. For now, oil is probably one of my least favorite, like least trusted assets right now, just because I don't know if we're trying to put in like, is this an interesting like head and shoulders pattern on oil where it consolidates here? Does oil have a spike higher coming? I would think there's a lot of pressure to keep oil prices below, $80. But I don't know. I mean, this could be setting up for like a head and shoulders pattern where we get a squeeze and all of a sudden we want this inflation story to go our way, but maybe it doesn't. Maybe energy prices are going to be what throws it all off. So to be determined. But for right now, the trade I have running on oil is a CL position for crude light futures, or light crude oil, duh. But CL, I put in a $50 support level. So that's why I have the alarm here. As long as price stays above $50, I make about $200 on the trade. But I've got that on like 15 accounts. So it's just a little futures trade. I think I'm profit potential is up to like 750 if I get a profit trap, but we'd have to make fresh lows in oil for that to happen. Otherwise, it's pulling my $200. Okay, natural gas. down to some fresh lows again. This is why I'm trying to actively lower my cost basis on the diagonal spread that I have. Gold, I still think a correction in gold is hopefully happening. A 144 to 200 moving average would be lovely for me to start buying in. I do have some naked puts. I do have some 111s. I'm just going to wait to add more. I want to add more gold exposure, but it's probably going to be in the low 3,000s, 3,100, 3,050, $3,000. This 200 moving average is right around 29.90 right now. Still want to position off it. Still want to see this as a support zone. I think this is a great spot to be getting long. So I'm trying to be patient. Maybe gold offers it, maybe it doesn't, but I think we at least try to retest this low here. I think we try to retest this low here. We go a little bit lower. I like that bounce, and this probably heads. What's going to be interesting is if we get the reflexive move off the 200 moving average, we probably go right back to the highs. So if we hit that level, I'd love to see just a big snap move where we go all the way back up, and that just becomes an easy directional trade. So I don't necessarily have to be like investing in gold longer term, but like going out 3-6 months, just having it stay above the line in the sand. It gets above that, get paid, and maybe stagger out some expirations. So I will probably do that on gold. If we find my levels, I will go out maybe 3, 6, 9, 12 months, and if price is higher, I'm going to get paid earlier, later, but have that staggered out where it's like, I like the price level. I've been patient for that. Now reward me for the next, 12 months, hopefully with a little windfall of profit. Okay. So keep an eye on that one for gold. Silver, choppy right now, but I think that the posture looks pretty good. I think this is a solid looking bull flag. Use a slightly thicker line here. This is a move up, a little bit of a bull flag. If this posture maintains a break higher, if we break 37, okay, if we break 37, I think we make a run to 40 plus. So if we break these highs, 37 plus, I think we make a run into the 40s. My target on silver is close to $50. So 48, 49, 50 trailing stop losses, looking to see how that correlates with silver futures or SLV. But I think silver has a good looking move. On the day chart for gold, shaping up as a rising wedge. You see a rising wedge here? I don't really see a rising wedge. You're talking this. I mean, I see an ascending wedge for right now. I would say an ascending wedge means it depends, right? If this is here to here to here to here to here to here to here, if we have equal highs, sometimes this is a much more bullish pattern. An ascending wedge is usually what got us there. What got us there is bullishness. Now price is having equal highs, higher lows, equal highs like that. That's kind of the textbook ascending wedge. Usually that pattern is a breakout to the upside. If I was going to see a rising wedge, which means we'd be making, let's say we go up here, we have prices making higher highs, higher highs, higher highs. That type of narrowing would be the rising wedge where it's okay, now we correct. Make sense? So if anything, I think we're just accumulating at resistance and trying to find some support. I think this might be a little bit too aggressive. I wouldn't want to sell this. I don't want to sell gold. If I sell gold, all I'm doing is I'm trying to quick sell it to buy it right back. So I'm just going to pass on the selling and just wait and see if price comes to a level that I'm interested in, which is this 144, this 200 moving average. Again, more consolidation is fine. Consolidation here is fine. Some traders look at that and say, oh, it's breaking a trend line. Well, if it's just coming down to equal support, to me, I'm going to buy the dip. So I like gold for that. Okay. So mostly it's just I'm determined to kind of wait this thing out. The 144, 200 moving average to me, good enough, and then stagger out some expirations and try to get paid. Okay. Silver, like I said, maybe a bull flag here. Hopefully we hold above this like 35.50 zone. Any pullbacks at like 35, any pullbacks at 33.60, it's totally fine. Any pullbacks into these dynamic support levels, totally fine. I mean, we hit the 200, rallied, hit the 200, rallied. So even if we were to pull back, if we pull back, I mean, this is either a bull flag that continues to run, or this is a run up here and we pull back again. We find channel support, and I'm going to buy channel support, trying to get back to all-time highs again. Or not all-time highs, but recent highs. Okay, so I still like silver. Bitcoin at 108. I mean, I don't know if Bitcoin is trying to fake us all out or if it's going to make a real break. mean, we have some consolidation here, a lot of consolidation at the top. Again, nice little move, spot to accumulate. I was thinking that this whole big, beautiful tax bill would be enough to maybe push Bitcoin higher. Maybe with the Fed cutting rates later this year, maybe this helps propel Bitcoin higher. I'm not sure. This is kind of just a big nothing burger until our chart alarms break. If we go greater than 112, are we going to 120 plus? Maybe. If we break down below 100, I don't really want to see this getting back below like 75. There's still room to be bullish, but I don't want to see too big of a correction here in Bitcoin. It's just a big range trade, but it's going to be way less fun. So the hard part is like, do you have to just buy it now and be happy with that? Well, there's ways to do it. I mean, I'm buying now and willing to buy lower. I'm also dollar cost averaging into IBIT with no cover. So I have support, I have puts to cover my positions in case we go down, but I'm not covering the top because we've had a lot of like suppressed, because the options market, we've suppressed the upside, I think, quite a bit in Bitcoin. There's lots and lots of sell call options right above these highs. And for good reason, it's income. But at some point, if we push those levels and we flush through that liquidity, I don't think there's a lot stopping it. And if we start making highs at 120, 130, maybe even gamify this thing a little bit going into like the 130, 40, 50 zone. I mean, IBIT runs way up here. I mean, I would start selling premium if I think we've had a great run. Okay. But until then, I mean, it's just sideways. And if there's more chances to accumulate here, that's okay. Just be patient. But I think by the end of the year, we still see some highs on Bitcoin. So I think right now, my outlook for the rest of the year is this. If we just get through July, August, September, expect a pullback of some capacity, pause pullback. I think the market's, it's a bit overbought. It's a bit extended. We've got a lot of moving averages to find some support. We've got some pockets and gaps to fill. I hope the market does that for some efficiency sake. But I want to position for another run into the later half of the year. Okay. I think that having stocks, gold, silver, Bitcoin is a great way to have a pretty simple portfolio, but participate with some upside in a bit of everything. Okay. So yeah, I mean, I want to see markets go higher this year. I think they can. I think we have the landscape for it. I think that we had a very hard pivot fundamentally from the trade war in March and April into Liberation Day into now, April 9th forward has been just nothing but a melt up. So a summer pause, summer pullback makes sense. To what degree? I said like something between like 5 and 10%. We get that little flush. Great. Let's see if the market's interested in buying the dip. I think the market would be interested. I think, retail traders are certainly interested. The big surprise this year to me would be that we have no rally and we have just, this is the high. The market is doing what every perma bear macro analyst is telling you, which is, remember back in 2007 when the market went to all-time highs and then it crashed? Yeah, I remember that too. That's what everyone's saying we're at. We're saying we're right here. I don't believe that. I don't think that we're there. Do you think that the world learned anything from 2008? I think we did, or else we wouldn't have had like 17 years of a crazy bull market. The stress tests, the regulations, the deregulations, like I think the market is way more equipped with faster cycles to handle some type of stress in the markets. Maybe. I mean, honestly, maybe it's all just a house of cards. But companies are still existing. Companies still make money. There's things to be optimistic about. I just think that in the column, if we go column of positive news versus negative news, I think the negative news is starting to stack up with a lot more items versus positive, right? Positive is we pivoted from a trade war to a trade more. We have now a pro-growth administration. We have AI, which is the future. We have earnings, which are, maybe that's a question mark for these next couple of weeks, this next month. Is our earnings good enough to justify the valuations we were at in the U.S.? Right? And the argument is, well, Chris, just invest elsewhere. Go non-U.S. Okay. For the first time in a decade, I finally get paid in European stocks. For the first time in a decade, I see non-U.S. outperforming. It's like, look, you've got super liquid, high-flying stocks in the U.S. Learn how to trade options, generate income. I don't mind owning Tesla. I don't mind owning MicroStrategy. I don't mind owning the SPY or the Qs. Use options around them to lower my cost basis. I mean, I owned the SPY at 485 this year, and took the melt up to like 585. I thought that was a pretty good trade. And here we are trading at, 610, 612, 6. It's like I still left some money on the table. But are earnings good enough in these next 3-4 weeks to justify why we're at these highs and sustain these highs? Or is it going to be a little bit of a cooling off earnings through the summer? Maybe the market pulls back because of that. Is there an earnings compression where things kind of, die down a little bit? But I just don't see why the positive column is just so. It's to me, it's like it's all on hope and optimism versus the real effects of what is happening under the surface. Do we have a lot of potential risks? Maybe. And we've obviously seen a lot of complacency in the market. We're like, just the markets go up. So I think managing risk is the most important thing. Make sure we're not surprised by the downside, but markets seem to just not care that much, Good question there. Maddie's asking about when you start selling premium versus holding. A lot of that depends on the volatility environment. I mean, for me, anytime I'm looking to prefer selling premium, it's when the VIX goes up. So if I have like a big spike in the VIX, like we saw this year, I mean, once we started to see the VIX at 40, 45, 50 and change, again, it's a risky trade because markets are falling off a cliff, right? But selling premium into the indexes, it was courage to sell all that premium. But once we had that reversion happen, I mean, all of those trades paid out really, really well and very quickly. So, if you see a high VIX environment, if you run any study, like, I mean, I could do something as simple as like, if I just sold a naked put when the VIX is above 30, you're going to see an equity curve that pretty much looks like this. Okay. If I did an iron condor when the VIX is above 30, you're going to see an equity curve that looks the same. It's like anytime you're a seller premium with a higher VIX from like 30 plus, number one, it's rare. It's rare to get the VIX above 30. So if we sell premium at that kind of checkpoint, it usually pays pretty well. It's not perfect, right? Individual stocks will move and indexes will move and there's volatility and things go faster and wilder and crazier than you can expect. But for the most part, the reason that you sell premium in high VIX environments or high volatility environments is because the expected move based on volatility is oftentimes way greater than the actual. That is why selling premium works, because the markets are like, holy crap, this could happen. And they blow out these expected moves. And then the actual is a fraction of that. Right. And so you get paid on selling the outside moves and the market moves less than that, which is why premium selling works. And this is pretty true for the most part in any environment. I mean, a lot of times brokers, market makers are showing the expected move is typically slightly greater than the actual. But with the advent of zero DTE, 0-day trading, I see that sometimes there are days where the actual is greater than expected. And I see that happen a lot more in a low volatility environment than I do in a high volatility environment. So anyway, like I said, to answer Matt's question, I think that it's just based on the VIX to me. If I get the VIX above, 30 is great. Above 20 at 25 is good. But above 30 it's like pick your battles. Don't go all in at 30 VIX, because like 30 VIX can become 40, 50, 60 VIX like we've seen. It did that here. It did that here. You go back into 2022, we had several spikes into the 30s. You see this back into the Volmageddon events we saw back in COVID and 2018 as well. But a 30 VIX is like, be cautious, pick your battles. But if we go from like a 30, 40, 50, 60 VIX, I'm taking little bites. I'm taking little stabs. You can define risk. You don't have to take any crazy, stupid risk like naked puts, but you can still get a lot of good trades. And you can go way out of the money and typically way bigger than the expected moves. Okay. All right, good stuff. Okay, what else? We did dollar index, we did oil, gold, silver, we did some Bitcoin, MicroStrategy at 396. I need this thing to stay above 390 by the end of the year. I think it will. If Bitcoin goes higher, that's probably going to happen. Ethereum, I still don't want to trade Ethereum. I like the trade. I like the technicals. If there's some traders out there that are interested in a small trade here for a swing, area 1, maybe a pullback into this efficiency for 2, maybe the lows at 3. It's not a bad investment. If you ask me, like small, if we have like the network effects of Ethereum, then sure. I think we get back to, this isn't even all-time highs, by the way. This is just a catch-up trade. So I like Ethereum. If we look at the comparison between Bitcoin and Ethereum, so if you go BTC ETH, I mean, this recent move is benefiting Ethereum. So is this a high-low Lower high, lower low. Are we going to get another push on Ethereum that outpaces Bitcoin? Maybe. Maybe that's the catch-up trade. I mean, Bitcoin has been killing Ethereum since summer last year. June, July of last year, Bitcoin has been way better than Ethereum. But put in a bit of a top here. Does this mean anything? Maybe. Maybe it consolidates here and it just stays range bound. But if this is ripping up, pull back, and then one more flush lower to go against this, like I don't know how technical this is going to trade, but if this is a low to high and the market puts in a high, low, lower, high, lower, low, then yeah, maybe Ethereum catches another bid and plays catch up and outperforms in the, let's say, medium term compared to Bitcoin. I still like Bitcoin, but again, as a trade, I don't think Ethereum is a bad trade, right? So if you participate in a light position here and then efficiency and then the lows, I think if you're giving yourself enough of this investment, I don't think we're going too much lower than the 1400 level. So if we buy here, there's still risk to reward. If I buy here, there's even greater reward to risk. That's the type of trade I'm looking at. So as a trade, it looks good. I just don't love it. Like, what do I do on this? EETH is, ETF. It's like, can I sell a 30? Can I do a, put here? It's like, I probably can. EETH. We'll see. I mean, I go out to the end of the year, December, January. Put I'd be looking for is like $30. Premium is garbage. Like, so I'm not going to take the trade. If we came down to like $30, I would like to sell some premium, but it's down to like 5-cent credits. Like, that's a terrible trade. If it's at the money, I can get $5 or $6 for it. So for me, what I'd like to do is, let's say we pull back to, I'm going to go $30. Okay, we pull back to $30, pretty much at the lows. I'll put in some naked puts. We pull back to, let's say, $37.50, maybe that kind of halfway point. So I might look add some premium, be willing to own some Ethereum. Okay, but at current prices, probably not going to do anything. If I just put in like $1,000, it's like, what's that pay? If I put in $1,000 and it goes up, let's do some percentages here. So $1,000 pays $750. Like, that's a good trade. That's a good trade. It's not awful. But what happens if it goes down? Well, then I have to do $1,000 here and probably another $1,000 here. And fingers crossed that Ethereum doesn't go to garbage, right? So again, could be worse. It's a light exposure, but I mean, for basically a 75% upside with limited risk and good posture, I think Ethereum does look pretty good. We still have to have some risk on trading. That is for sure. We have to have some risk on trading. Any thoughts on the Nikkei? I don't know. It's behaving like the US. So Nikkei, I mean, Japanese yen is I don't know, probably the 9th one of the world as far as like its mystery and mystique and enigma. I have no idea what the Japanese yen is going to do. I'd love to see the Nikkei get to all-time highs. We're still stuck between this July to August correction from last year. So does it find a way to get back to these highs again? I hope that it does. I'd say it's postured more bullish than anything else. There's clearly some support in here. There's just it's up and still grinding higher, grinding higher, grinding higher. If it does get to these highs and beyond, off we go. If it's resistance and it rejects, well, you're looking at the same range I see. This could be heavy resistance. This could be support. We could be in a no man's land where the Nikkei doesn't go up or down. It's just a big range. And this is like a 20+% range. That's the hard part, is we could go nowhere and this thing is stuck between a 28% range from high to low. So that's a good opportunity to be buying low, right? But frustrating if you're trying to buy. It's like you're a bag holder with the highs and you're down 20 to 30% drawdowns. So I think again, global melt up is probably more of the likely scenario since the Fed pivoted, or the U.S. pivoted so hard this year. I think if the whole world is willing to spend money, the whole world's willing to adopt a more fiscal largesse type thing, where it's like you're just willing to spend, add to the deficits. Who cares? We'll worry about it later. Grow your way out of it. Like, if that's the world's policy right now, I don't know how these markets don't continue to melt up. And maybe that's the other big thing that hasn't been priced in yet, where this market can continue to go higher, which is why I'm not calling the top on anything. Right. So that's my thoughts on the Nikkei. It's like it's postured higher, but still we got to do some serious work to break above range resistance, range support. I think if we break above range highs, great. Okay. Copper, Japanese yen waiting. Japanese yen here. DAX getting back to highs again. Shallow. I'd like to see some more consolidation. You know, coming back to the 236 and getting to the highs again. I'm hoping that we just go sideways. Maybe summer sideways, and then maybe this continues to make a run. I'd like to see a bit of a better pullback. I'd like to see like the 30, 38, 50% pullback if possible. But if we just consolidate here, to me, this is a pretty good rip bull market that is likely going to have some more love. Price to earnings on Europe is way cheaper than the US. So money is going there. If Europe just does remotely well, it's probably good upside versus the US has to be kind of perfect. You know, and US companies are pretty amazing. I mean, companies are huge. They make a ton of money. Their profit margins are growing. I just wonder how much of that profit margin they're spending on CapEx and you know, AI, which could be great in theory, but could also like, hey, you're spending all your money, like you're spending all your profits, and I get it, it's for the future in this arms race, but are you going to get the ROI? Are shareholders going to get the ROI? Time will tell. FTSE, kind of the same thing, shallow pullback, maybe some consolidation near the highs. I'd like to see like a 30 to 38% pullback. Argentina, maybe if we get below the 200, then back above it. China still hanging in there with some higher lows and higher highs. Brazil looking better. I'm liking Brazil to the upside. I'm liking ILF, which is Latin America, to the upside. I think those look pretty good, and they're beat up like crazy. MAGs down off these recent highs, not at all-time highs yet. Again, MAG 7's been split pretty hard this year. NVIDIA and Meta and Microsoft have been like the top performing MAG 7s. And then you have Apple lagging, you have Google lagging, you have Tesla lagging. AVGO got added into the top 10 because it was $1 trillion company. It's ripped like crazy, but yeah, I mean, it's kind of a separated or segregated MAG 7 now. Some are, you know, at all-time highs and some aren't. It's a big difference. Apple had a nice little run, but still, I mean, Apple from a daily chart still below the 200 moving average. I mean, look at how many stocks were down in April that have ripped back above the 50-day and the 200-day moving average. Apple is not one of them, not yet. So based on earnings season this next like 2-3 weeks, does Apple get above the 200 moving average or doesn't it? I think it's going to be important. If Apple gets above the 200 moving average, then we can see higher highs. If we stay down here and MAG 7's underperforming, I hate to say it, but MAG 7 weighs, the weight is so severe that we have to see like solid MAG 7 earnings for the markets to go up. Okay, or we have to see an intense rotation out of MAG 7 and go hog wild into the 493 stocks elsewhere. And that's, I don't know if that's a big risk. I don't know if that's a bigger risk than just sticking to MAG 7 right now. Amazon, kind of in between. It's doing okay. It's above the 200 moving average. That's good. Are we getting back to all-time highs anytime soon? I mean, if I believe Amazon logistically is going to be an AI-based company, I think they're going to have humanoids. I think they're going to be highly efficient. They're a huge disruptor in the industry. They've crushed so many brick and mortar stores over the years, but they've changed everything about convenience, in my opinion. Broadcom, I'd like to see a bit of pullback since we are overbought with divergence. Google, good support around 140, but still like just chopping around this 200 moving average. Meta ripped like crazy. Microsoft ripped like crazy. Probably some pullbacks are needed. Overbought conditions with divergence, but you know, do we get a pullback? Doesn't have to be anything crazy. It's like, do we get a pullback to 23%, to 30 to 38%? Netflix just off the recent highs. Netflix has earnings next week. NVIDIA, big old comeback from 87 up to 160, almost 100%. All the NVIDIA lovers got saved in a big way this year, up 85% from those lows. But I think a pullback's needed. I still think we go higher. NVIDIA still has a big head start in the chip world. Tesla doing better. If Elon must have just shut his mouth, and maybe Tesla wouldn't be so volatile. But can't fault the guy for trying, I guess. We got a president that doesn't shut his mouth either. So it's you know, as they say, it's the immovable object and the unstoppable force. So you have one of the wealthiest people in the world versus a president of world power number one. It's an interesting battle. You know, so I mean, at first I was like, I think Elon Musk is more like Tony Stark, and now he might be more like Lex Luthor. Who's the wrestler? Luthor is the supervillain. I think Lex Luger is the bodybuilding wrestler. Very different hairstyles. Anyway, bonds. TLT is down. Yields. Bonds are up. Yields are up. Look at this. 1, 2, 3, 4, 5 days in a row. Yields are higher. What's this? I would assume that some of this yield increase is the big beautiful tax bill. You know, if we're adding $4 to $5 trillion for the next 10 years, doesn't surprise me this is going higher. So, I mean, I don't care what's being said. I don't care what trade deals we're inking. If yields are going up, this does put a bit of a chokehold on growth. It makes it difficult to grow at 4.5%, 5% interest rates. Okay. And these are like raw interest rates. Nobody's really getting this to borrow. If you're a business, you're not borrowing at 4.41%. You're not buying a house at 4.41%. It's based off of this with the markups, right? Your average mortgage is still like 6.7. Yeah, 6.67 right now. So anyway, we'll see. Gold dying. I mean, it needs to pull back. Pull back to the 200-day moving average. Okay, and then currencies. One more glance, and I'll wrap it up. Currencies. Big pop in Aussie with that pause this overnight. They were expected to cut to 3.65 or 3.6. So they were forecast for a 25 basis points cut. They did not. They paused at 3.85. We have RBNZ tonight, expected to pause at 3.25. Maybe they'll do the same. Just maintain the pause, right? So it's interesting that we've had a surprise in the currency rate landscape. That usually doesn't happen, but that's this week. Pretty light news overall. Tomorrow, meeting minutes at 2 p.m. Thursday, unemployment claims for the U.S. Like it's pretty light on the calendar. CAD unemployment, since they didn't squeeze it into Thursday like we did for non-farm payroll, and we'll see where the rest of the week goes. But like I said, earnings kicks off next week. CPI, PPI next week. And once we have that combo with earnings, let's see like what's inflation going to tell us, what are earnings giving us, what's forward guidance from banks and financials. Like this week, I could see mostly sideways, in all honesty. You know, last week with that little holiday run, maybe we're putting in a bit of a top here, and maybe we stay in between. Like maybe this is an inside candle week where nothing really happens. That's okay. Right? That's okay. But really, it's like, okay, do we break higher or do we break lower? Just be aware, like there's going to be price action that has to build up and give us some confirmation if this week is a nothing week. Okay. All right. Any other charts, any questions? Otherwise, I'll let you go, and let's come back and do this again tomorrow. Things are pretty dead even right now. Put and calls equal. Price has gone next to nowhere, so very quiet day thus far. This is my intraday price action, like very quiet, which tells me that I should have a position doing pretty well this morning, at least one of them. Yeah, it's up about 35%. Trying to eke out a little net window there if I can. So we'll see. All right, I'll let you go. Come back and do it tomorrow. See you, bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.